Welcome everyone to another episode of How to Make Money in Stocks with Investors Business Daily. As you can see, Amy is not here this week. She's on a much-deserved vacation. Now in this week's show, we're going to talk about the base-on-base pattern since we've seen a lot of them in this recent choppy seesaw market. We'll talk about how it works and how it can give you a second chance to buy into a leading stock. But first, let's take a quick look at the market. The market had a solid update on Thursday, and then came the surprise results of the Brexit vote, with Britain deciding to leave the European Union. The market did not take kindly to that decision, and what looked like an encouraging sign of renewed strength on Thursday turned into a sharp sell-off on Friday. The Nasdaq fell more than 4% and plunged below both its 50 and 200-day moving averages. The S&P 500 fell nearly 4% for the day. While the Brexit vote clearly rattled the markets, and airline and bank stocks in particular sold off sharply, there were signs of resilience among IBD 50 and other leading stocks, particularly those with less exposure to the European markets. Building sector stocks Vulcan Materials and Martin Marietta Materials rebounded after coming down to their 50-day lines, a sign that fund managers were stepping in to support those holdings rather than just making a beeline for the exit. Building product retailers like Beacon Roofing Supply and Tile Shop also held their own. Beacon bounced off the 50-day line and closed the day below a potential 45.82 breakout. Note how the relative strength line entered new high ground, showing Beacon is outperforming the general market. For any stock that you own, and maybe something that's pulled back a little bit or is hitting resistance, take a look at the relative strength line to see how it's stacking up relative to the rest of the market. Other big news items this week included stress test results for the big banks. They all passed the first round, with round 2 results due on Wednesday. And Tesla Motors' decision to buy SolarCity, which is already run by Tesla founder Elon Musk. And what did investors think of that move? Well, here is your answer. Tesla stock fell over 10% on Wednesday and continued lower from there. We have a few notable names on deck to report next week, including Nike, Acuity Brands, Constellation Brands, and Paychex, which has been testing a new buy point in recent days. For more on what to look for in the week ahead and for the latest Brexit news and how that may affect the market and leading stocks, stop by our website at investors.com/investingshow. Since we've had a seesaw market for quite some time now, it's not surprising that we've seen a lot of leading stocks form a base-on-base formation. So let's take a look at that pattern, how it works, and how it can give you a second chance to get into a leading stock. Dollar General is one example of a recent base-on-base. The simple rule is, if a stock breaks out, then begins forming a new base before rising at least 20%, then the new pattern and the prior one count as one base-on-base formation. Dollar General broke out of this cup with handle in March, then began forming this flat base before it hit that benchmark gain of 20%. Now, note that the weekly closing prices in the bottom of the flat base were right around the area of resistance the stock hit last summer. That's healthy. It shows that Dollar General is turning a former area of resistance into an area of support as it tries to climb higher. Amazon is another example. It cleared this long second stage consolidation back in April 2015. Then it went into this tight sideways pattern and formed a new flat base. It broke out of that pattern in July and rose as much as 28%. Since it gained more than the 20% that you look for before pulling back, this new consolidation is no longer part of the earlier second stage base-on-base. It's now considered a third stage pattern. Amazon is also a good example of how a base-on-base formation can give you a second chance to buy, either to add to an existing position or to establish a new one. For example, if you missed Amazon's breakout in April 2015, you could have used its base-on-base breakout in July to pick up shares. Fortune Brands Home and Security is another example. It reset the base count in February when this new low undercut the low in the prior pattern. The stock then broke out in March, but pulled back to form a new base before rising 20%. Like we saw with Dollar General, the bottom of Fortune Brands' new pattern was right around a prior area of resistance, and is now testing that area again, which is also right around the 10-week moving average. See if it finds support and manages to break out of this first stage base on base. The Tile Shop is another example. We're looking at the daily chart here, but you can see how the stock struggled to gain traction while forming multiple bases since April 2015. Since it never gained more than 20% after each attempted breakout, these three consolidations and its most recent one all count as one first stage base on base. Now again, note how Tile Shop also found support in its new base right around where it hit resistance in the prior pattern. A big question now for these stocks and others is, will the general market cooperate and create an environment that makes it easier for growth stocks to make a more sustained climb? As we wait for that question to get resolved, keep an eye on stocks that have strong fundamentals and are forming a base on base or other chart pattern, and pay particular attention to those that are turning former areas of resistance into areas of support and are showing market-leading relative price strength. Before we wrap up, I just want to remind you to visit our homepage of investors.com/investing show to get notes on this week's episode, including links to more information about the base on base and other chart patterns. And again, you'll find all of that at investors.com/investing show. We'll see you next week.